Rise and Shine with Don Getling and Gino Franti on the National Real Estate Cafe. And I'm just making a little pun just for you, Don. Are rates rising or not? What are we looking at?
Well, you're going to hear a lot about this now because we've had so much going on with Greece, so much going on with China, so much going on with Iran. So the big factor you're going to hear a lot about now, because the Fed is going to be meeting in September. And the question is, are they finally going to raise rates? I mean, it has been since December of 2008 since they've touched the rates. So look at this first chart. Where were rates? I bet you didn't even remember that back in the heyday, August of 2007, right before the financial crisis, we were at 5.25%. That's what you had to basically borrow funds at.
So let's clarify this. These are short-term rates. This is how banks borrow money overnight for short-term, very short-term loans. Very, very short-term loans. This is how much it costs the bank to borrow money.
And then they add a margin on top of that with what they make on it, usually around 3%. So back in 2007, believe it or not, if you were to have an equity loan of some sort, you were at 8.25%.
That's right.
Now you're at 3.25%.
Yep.
So just to give you some idea of what factors in. So what is going to help us determine if the Feds are going to raise rates? Well, here's the first one.
Don's favorite is jobs, right? And I love this number, right? 255, best number in 42 years. Hey, that's great, but more importantly, if we look over the last quarter, and Don and I have always said the psychological barrier for jobs is 300,000 layoffs a week on initial claims. We've been well below that number. We've come close to it a couple times, but nowhere near the 455 that we talked about back when everything was crashing.
So with job confidence, that gives the Fed a good reason to raise rates, saying, okay, the job markets are strong. Here's another big one that is affected by jobs and will affect their decision quite a bit.
Yeah, GDP is a really interesting number, and I think that one of the things that's not shown in this chart is how real are these numbers, right? And I know that we talked about it a little while ago, Don, is this horrible negative 6.4 number. That was very real. But this positive 5.6 number, I mean, that's like almost a 12% swing in the economy. How did that happen?
Well, it's called steroids. Steroids for the economy, meaning stimulus. There's multiple stimulus programs going on there between QE, meaning quantitative easing, pumping money out there. There was the cash for clunkers for cars, and there was first-time homebuyer credit, which was huge. It was one of the biggest booms for real estate in quite some time, which really helped our economy kind of get a little kickstart.
Yeah, and we also at that time, as you saw in the prior chart, in December of 2008, we had dropped the rates to nothing. So that also takes a little bit of time to come back, and this is a reflection of all the stimulus that was done. And then you see that we've been able to keep pretty much above the line most of the time. We've had a couple of low reports below the line, a couple of negative reports, but definitely more positives than negatives.
And this is without the stimulus lately. So that means this is a real growth economy. So that's a factor that the Fed's going to look at, and when is the time to raise rates. Here's a couple other factors to look at. This next slide, consumer confidence, huge.
Yeah.
I mean, they're not going to raise rates if confidence isn't up because they don't want to deflate the confidence and therefore the economy. And you can see we've had quite a consistent increase in consumer confidence.
Yeah, and so consumer confidence controls consumer spending, and consumer spending controls GDP, yada, yada, yada. You get the point. So if consumer confidence is good, everything else will follow. And what we want when the Fed raises rates is we want everybody to go, so what?
There you go. So, and a couple other factors will be inflation, inflationary numbers. You can see we had some kind of higher numbers with consumer price index, which is more the consumer, just like it says, versus the next side, which is the producer price index, which also measures inflation, but that's for the sellers. They're selling the products. So these are big factors, though.
The reason you want to look at producer price index is if the cost for the producer goes up, then eventually that trickles down into the marketplace, or it squeezes the profitability of the companies that are trying to sell it if they're not able to pass that on to the consumer. However, like I said, if the consumer is confident and they raise your price of something, you just say, so what? By the way, has anybody seen almost $5 gas lately and said, so what?
Not me. So we're going to see what happens. They're going to meet on September and December. We don't know when they're going to raise rates, but trust us, you've heard it here that they are going to before the end of the year. The good news, it's going to be at a very moderate pace, which is the good news and why rates are still staying down. So you heard it here on the National Real Estate Cafe. You can get these reports on a daily basis by texting NREC to 58885. NREC to 58885. Check us out at nrecafe.com. See you tomorrow.